Hello students, this is Dr. Prerna Singh, Assistant Professor at Jaipur National University. We, School of Business Management, are happily announcing the beginning of our new session of BBA BCom and BCom Honors 2020. JNU has obtained the top ranking among all the colleges in Rajasthan, so this is a proud moment for all of us. I just hope that you all must be joining the Jaipur National University with all your zeal and enthusiasm so that you can encash the opportunities. We welcome you all with our whole heart. I'm going to teach you the subject fundamentals of accounting and financial accounting, that is the backbone of your course. Many of you must be afraid about the subject accounts, so I'm just going to tell you very positively that you don't need to afraid about this subject anymore. So this is your first class. With this class I'm going to teach you accounting terminology. So any one of you has any kind of phobia or any of you are from non-commerce background, you don't need to be afraid anymore. So this is our first lecture in which I'm going to teach you the accounting terminology. Accounting terminology covers accounts payable, accounts receivable, audits, balance sheet, equities, assets, liabilities, etc. There are a number of topics in our accounting terminology. So first that we must understand, because all the activity starts with a transaction. So what the transaction is. Transaction is the transfer of goods and services and money. So we take an example. Suppose Mr. X are going to sell some goods to Mr. A worth rupees 10,000. So in that case, Mr. X is the seller and Mr. A is the buyer. So Mr. X will be transferring some goods to Mr. A and Mr. A will be transferring some money to Mr. X. So this is a transaction. So there are two types of transactions. First is cash transaction and the second is credit transaction. In case of cash transaction, see, if Mr. X is going to receive the money from Mr. A on immediate basis, so it will be a cash transaction. But in case of Mr. X will be receiving the money after some time, so this will be a transaction of credit basis. Next is proprietor. Proprietor is the person who owns the money, who invests some money with an intention to receive some profit in future. Capital. Capital is the amount invested by the proprietor. Capital can be increased with the increasing profits, as well as if proprietor invests some more money, that will be counted as the additional capital. Capital can be decreased by the increasing losses, as well as if any amount is withdrawn by the proprietor. So capital is the amount that is being invested by the proprietor. Next is balance sheet. Balance sheet is that financial statement which covers all the aspects of a company, which is to be published by the company and which is made to present the true and fair value of a company. Balance sheet is a report of the company's assets, liabilities and equities. So all the things which are covered in the balance sheet are these three things: assets, liabilities and equities. So balance sheet are having two formats. First one is vertical format and second one is horizontal format. In the vertical format, we are having liability column first and then the asset column will be coming. But in case of horizontal format, on the left side there will be the liability column and on the right side there will be an asset column. But what we need to understand is the basic accounting equation, which is being cleared with this diagram. Like assets are equals to liabilities plus equities. Like from liability and equity we are collecting some funds and which is being utilized on purchasing some assets for the business. Next is assets. What are the assets? Assets are the properties being purchased with the help of money invested by the proprietor. Assets can be of two types, which are tangible and intangible. Tangible assets are those which has some physical existence, which can be seen and touched. Like this furniture, this laptop, all these things are tangible because these can be touched and seen. But there are some intangible assets as well, which cannot be seen. For example, patent, copyrights, etc. So these are kind of rights which provide some kind of possession to the company, but they do not have any kind of physical existence. Next is liabilities. Liabilities are the financial obligation for any company, for any organization. So liabilities has two types. Like first is long-term liabilities and the second one is short-term liabilities. For long-term liabilities are those which have the tenure of more than a year, at least more than a year. And short-term liabilities are going to be paid by the organization in less than a year. There are some examples of liabilities as well, which we are going to cover in our next slides. So, drawings. Drawing is the cash withdrawn by the proprietor. So, proprietor can withdraw some money out of the amount of capital whenever required. But the proprietor have to repay the amount of the drawings withdrawn when the company needs the money, and the company can charge some interest as well on that particular amount. Next is debtors. Debtors are those persons who actually going to pay the money after some time to the company. For example, let's take an example. If Mr. X has sold some money to Mr. A, okay, and in this example, Mr. A is going to pay the amount to Mr. X after some time. So in that case, Mr. A will become the debtor of Mr. X and Mr. X will become the creditor of Mr. A because Mr. X is in the position of having the money after some time and Mr. A is in the position of paying the amount after some time. So here is the creditors. So creditors are also shown as a liability in the balance sheet and debtors are shown as asset in the balance sheet. But debtors and creditors both are the current assets and current liabilities, as the time given to the debtors and creditors will be a very short period. So they will be covered under the current assets and current liabilities. Next is revenue. Revenue is the amount generated by the company, the amount earned by the company. It can be earned from any source, like from selling the goods, from earning from the interest, earning from the dividends, etc. So if any kind of earning is coming to the business, that will be counted as revenue. Next is account. Account is the formal record in which we are going to maintain all the transactions that has been held between two persons. So if in my company I am maintaining an account of a particular person, so all the transactions that has been held between me and that person will be covered in this account. Next is accounting. Accounting will be a procedure of recording all these transactions. Like I'm maintaining the account of a particular person, so that procedure will be known as accounting procedure. Equities. This is a very important topic of accounting because equities are the owner of the company, but equities has the right of only and only the residual benefit in the shareholders' equity, because after paying to all the liabilities, to all the debentures, to all the loans, to all the creditors, and to all the preference shareholders, the leftover amount will be given to the equity shareholders. So in that case, equity shareholders will be the owners of the company, but equity shareholders are going to be the one who are named as the owner of the company. Okay, but equities are the third section of balance sheet after assets and liabilities. Next is gap. Gap are the principles, generally accepted accounting principles. These are rules, conventions, procedures. These are set principles to maintain the accounting records in the business. So, if an accountant is maintaining the record in the company, so he or she will have to follow the gap principles. Okay, these gap principles are maintained actually to improve the clarity, consistency, and comparability of the accounts of financial institutions. Next is goodwill. Goodwill is the reputation of a company. Goodwill is a premium amount paid in case of acquisition of a company. This can be calculated by excluding all the liabilities out of assets. So, if we are receiving some premium amount for our company, that will be counted as goodwill, because a business has been established for particular time. So, in this particular time, all the businesses may have earned some kind of reputation or some kind of goodwill. Next is journal. So, journal is a book which is maintained by an accountant in a company. In this journal, every transaction will be recorded. Like we have talked about this transaction, like I have sold some goods for worth rupees 2000. Okay, in that case, I will be receiving the cash. So cash account debit to sales account. That will be the entry which is to be registered in this journal. Okay. Next is ledger. Ledger is a book that actually contains all the information from journal but in a summarized form. So if I'm going to transact with a person in n number of times, like I'm purchasing some goods from Mr. X and then I'm selling some goods to Mr. X, in that case there will be n number of transactions between Mr. X and a person. So in that case, those all the transactions will be shown in the ledger account. That is the most important benefit of maintaining the ledger books. Okay. So ledger book is maintained from the journal accounts. So after going through these lectures, you will be able to understand how to make the journal entries and then ledger books. So here with this slide, we will be able to understand what are the current assets and what are the fixed assets. So current assets are those which can be easily converted into cash, like cash, accounts receivable, inventory, short-term investment, prepaid expenses, etc. But fixed assets are those like land, building, furniture, plant and machinery, and etc. So fixed assets are those tangible assets which are to be sustained for more than 1 year at least. Okay. So fixed assets are like land, building, plant and machinery, etc. So these properties are maintained for at least 1 year. As we are purchasing plant and machinery in any company, so the plant and machinery will at least sustain for 5 to 6 years or even more than 5 to 6 years. So this will be counted as fixed assets. These can be touched and seen, so they are having some physical existence. Next is current assets. They can be easily converted into cash and it must be consumed within one operating cycle period and at least 1 year. So examples are accounts receivable, prepaid expenses, cash or cash equivalents. Cash equivalents are like marketable securities, short-term investments, inventories, raw material, etc. Marketable securities are those financial instruments which are to be sold or are to be converted into cash within period of 1 year. These are highly liquid investments in the stock market. We have to purchase these investments from the stock markets or over-the-counter stock exchange. Next is prepaid expenses. Prepaid expenses are those expenses which have been paid by us in advance, that has not been accrued till now, but they are related to maybe next year or maybe next year. So in that case, these will be paid by the company in advance. Raw material is the material used to produce some goods. So raw material is the primary production sources, is the factor of production which is to be purchased by the company. It can be purchased from the suppliers and other sources. So raw material will be a part of asset in the balance sheet. Inventory is a type of current asset which will be shown in the asset column. So inventory covers raw material, work in progress material, and the finished goods as well. Net profit or net income. Net profit will be calculated after deducting all the operating and non-operating expenses, and it will be covering all the operating and net operating incomes. So net profit will be obtained after making income statement in the organization. Gross profit will be obtained with the help of excluding all the expenses related to the production of the product. Here is one formula given for gross profit ratio, that is total revenue minus cost of goods sold divided by total revenue into 100. So gross profit is the first ever profit for a company after deducting the cost related to the production of a product. Next is current liability. Current liabilities are those obligations which has to be paid by the proprietor in a particular time period, that is at least 1 year, or at most 1 year. So there are some examples of current liabilities like cash dividends payable, accrued expenses, short-term notes payable, accounts payable, tax payable, unearned revenues. So first we need to understand what are the unearned income. Unearned income is that type of income which has not been earned till now. The duties have not been performed by the proprietor, but this income is being received from the outside party. So it will be shown in the liabilities till the time this income has not been accrued. Next is outstanding expenses. These are accrued expenses. These are those type of expenses which has already been accrued, but we haven't paid this amount. So it will be a liability of the company to pay these amount. For example, outstanding rent, outstanding salaries, etc. Retained earning. Retained earning is a part of profit which is being retained by the proprietor, by the company, to invest it into the business itself. So there are different type of retained earning like P&L account and many that kind of profit which has not been distributed to the shareholders as dividend. So it will be retained in the organization for further expansions and modernizations. Next is provision. Provision is a charge against profit. It is created to meet the unknown and known liabilities. Like provision can be created for depreciation, for the debtors which are not going to be paid in the future. So provisions can be created for bad debts as well. But provisions are a kind of security that proprietors made for the future contingencies. Next is depreciation. Depreciation is a term that includes all the losses in the value of assets that are coming in the future. Let's suppose we have purchased a machinery or a plant which is going to survive for at least 10 years. So after 10 years, this machine is going to be depreciated. So after 10 years, we'll have nothing in our hands. So better would be making a provision in these 10 years for the depreciating asset. It cannot be created for land, but it can be made for plant and machinery, for furniture, because these are those types of assets which are going to deteriorate in the upcoming period. So there are some methods. Depreciation is a kind of non-cash expense. So it will be deducted from the P&L account. So there are different methods of depreciation like straight line method, double declining balance, units of production, etc. So we'll be going to understand all the methods of depreciation. So depreciation was covered by us. Next is income statement, which is a very important topic of our syllabus. Like we have already done the balance sheet part. Now we are going to cover all the aspects of income statement, that is P&L account, profit and loss account. So first we need to calculate all the revenues, the amount of sale which we are getting, and then we'll deduct the operating cost, the direct operating cost, that means the cost of producing a product. After deducting this cost, we'll be getting the gross profit amount, and then the indirect operating cost will be coming, like rent and salaries, other expenses, and then the cost of debt finance will be deducted, like interest on debentures, interest on loan, etc., and then we'll be getting net income. Okay, so net income will be calculated by the income statement, and it will be calculated after deducting all these amounts. Return on investment. If we are investing any amount of money on any project, so we are expecting some kind of returns after some time. So for example, if a company is investing some amount on marketing, so they are they are going to expect some kind of profit after this investment. So return on investment will be calculated by the expected return divided by investment into 100. Operating income. Operating income is received to any organization by the sources of operation of the business, but non-operating income will be received to any organization by non-operating sources such as the sales of plant and machinery. Okay. Next is the accounting conventions. Accounting conventions are the principles through which we are going to maintain our accounts in any company. Like the first accounting convention is conservatism. Conservatism is to have a conservatism approach, to be conservative while maintaining the accounts. Like some people are having this approach that we have to factor in the worst case scenario while maintaining the accounts. We have to consider each and every losses, but you don't need to consider any kind of profits while maintaining the accounts. Next is consistency. Consistency is the basic principle that you all need to maintain the same accounting principle throughout a year, throughout an academic year or an accounting year. So in that case, we have to maintain the consistency in all the accounting records like journal, ledger, etc. Full disclosure shows the method of disclosing each and every aspect in the accounting books. Like they are saying that you need to disclose each and every aspect, whether it is important or not important. You need to disclose each and everything. Next is materiality. Materiality says that we need to lay the cards on the table, but if they are important only. So if some things or some records are important, only in that case they will be disclosed. So these approaches are saying that you need to disclose only those factors which are material. We don't need to focus upon the immaterial things. So next is accounting concepts and conventions. So we have covered the accounting conventions. Now we need to focus upon the business accounting concepts. First is business entity concept. So we need to treat the business as a separate entity. In case of winding up or in case of distribution of profit, we need to just think that the business is a separate entity. Next is money measurement concept. Money measurement concept says that the business transaction related to money measurement or in terms of money are only recorded in the business. Next is dual concept. Dual aspect concept says that every transaction must be recorded in two terms. The first is debit and the other one is credit. So we need to make a corresponding debit transaction for each and every credit transaction. Like I've already said that if one person is selling goods to another person, the entry will be made cash account debit to sales account. So there will be two accounts affected. One is cash account but in debit, and other is sales account but in credit. Next is going concern concept. So we need to treat business as a going concern for a fairly long time. So business will carry on its activities whether the proprietor is surviving or not. Next is cost concept. So this concept says that we need to show the original cost in our financial accounts. We don't need to focus upon any kind of appreciation or depreciation that are going in the market. Accounting year concept, it says that all the accounting records has to be maintained for a specific time period that must be an accounting year. Next is matching concept. Matching concept says that an equal expense entry has to be made or recorded for correctly calculating profit or loss in a particular given period. Next is realization concept. Realization concept says that we need to record all the transactions only when they are actually being realized. Means we don't need to write any kind of advance money which is paid or which has been received by the company. We only need to write only when the amount is actually being earned. So that is all for today. We'll be covering next topics in our next slides. So for that time, good luck. Thank you.